How Trump tariffs impacted GM's profits and future plans. Brace yourself, the ongoing debate over tariffs is hitting home for America's biggest automaker, and the numbers are staggering. General Motors, GM, revealed this week that tariffs introduced under former President Donald Trump have slashed a whopping $1.1 billion from its operating income in just the last quarter alone. But here's where it gets controversial. GM expects the pain to get even worse in the coming months. Let's break down what's happening. In the second quarter, GM's core profit dropped by 32%, landing at $3 billion. The company isn't sugarcoating the situation, it's sticking to its earlier warning that trade-related challenges could ultimately cost it between $4 billion and $5 billion. However, GM is actively looking for ways to soften the blow, aiming to offset at least 30% of these losses through strategic measures. Revenue for the quarter ending June 30 dipped nearly 2% year-over-year, coming in at about $47 billion. Investors took notice, with GM shares falling roughly 3% in premarket trading. This isn't just a corporate issue, it's a workforce issue too. Nearly 1 million Americans work in automotive manufacturing, and GM remains the nation's top automaker by market share, employing around 162,000 people worldwide. In a candid letter to shareholders, CEO Mary Barra emphasized that GM is positioning the business for a profitable, long-term future as we adapt to new trade and tax policies, and a rapidly evolving tech landscape. This is the part most people miss. Adapting to tariffs isn't just about numbers, it's about rethinking the entire business model in a changing world. GM isn't alone in feeling the squeeze. The company has revised its annual profit guidance, now projecting an adjusted core profit between $10 billion and $12.5 billion for the year, a forecast it reaffirmed this week. The root of the problem? In early April, the Trump administration imposed a 25% tariff on imported vehicles and auto parts. According to the Yale Budget Lab, the average tariff rate Americans now face has soared to 18.7%, the highest level since 1933. That's a historic shift with ripple effects across the economy. To fight back, GM is investing heavily in its U.S. operations. In June 2025, the company announced plans to pour $4 billion into 3 American plants in Michigan, Kansas, and Tennessee over the next 2 years. This follows an $888 million investment in a New York facility to support the next generation of V8 engines. Barra told shareholders these moves will greatly reduce our tariff exposure, with new production lines expected to start up in about 18 months. But here's a twist, not everyone agrees on the long-term impact. A recent Brookings Institution report highlighted that the overall effect of higher tariffs on U.S. auto manufacturing remains uncertain, and could even be negative. Is it possible that these protective measures might backfire? Despite the tariff headwinds, GM's core business remains strong. U.S. sales, its main profit engine, rose 7% in the quarter, and the company maintained premium pricing on its popular pickup trucks and SUVs. In China, GM returned to profitability after a loss the previous year, showing resilience in a tough global market. It's not just GM feeling the heat. Stellantis, the maker of Jeep, warned this week that tariffs will significantly impact its results in the second half of 2025, estimating a $350 million hit so far. Meanwhile, U.S. inflation ticked up to 2.7% in June, as companies across industries raised prices to cope with the higher costs brought on by tariffs. And this is where opinions really start to diverge. Are tariffs a necessary tool to protect American jobs and industries, or are they an expensive gamble that ultimately hurts consumers and businesses alike? What do you think? Are these trade policies helping or hindering the U.S. auto industry? Share your thoughts in the comments below. Do you agree with GM's approach, or do you see a better path forward? How Trump's tariffs cost GM $1.1 billion, what it means for the auto industry. Big news in the auto industry. General Motors just reported a steep drop in profits, and the culprit may spark plenty of debate. The reason? Former President Trump's controversial tariffs have piled an extra $1.1 billion in costs onto GM's books. That's right, these economic policies are doing more than making headlines, they're directly hitting the bottom line of one of America's most iconic car companies. On Tuesday, the Detroit-based automaker announced it brought in $2.53 per share in adjusted earnings. That number beats what Wall Street analysts had predicted. They expected $2.33 per share, so at first glance, things look solid. But here's where it gets controversial. Last year, GM earned a much healthier $3.06 per share. The company has yet to lay out any specific strategy to bounce back to those higher, pre-tariff profit margins anytime soon, raising big questions about the future. But tariffs aren't the only factor chipping away at GM's profits. The automaker also cited increased warranty expenses, a cost that tends to reflect product quality issues, more repairs, or changing consumer expectations. On top of that, GM is facing a growing stockpile of electric vehicles. Why the sudden buildup? Under the latest federal budget approved during Trump's administration, crucial government incentives for EV buyers are set to vanish. This could dampen consumer appetite for GM's electric cars, just as the company shifted so much of its strategy in that direction. And this is the part most people miss: could these tariffs end up hurting American manufacturers rather than protecting them? Some argue that stiffer trade rules make it harder to compete globally and ultimately punish U.S. businesses and workers. Others say tough trade policies are necessary to level the playing field. Which side are you on? Where do you stand on this issue? Do you think tariffs are a necessary measure to defend American industry, or do they cause more harm than good for companies like GM? Share your perspective in the comments. Let's get the conversation started.